So, what if the real difference between stocks and bonds isn't risk, but taxes? So, let's get into it. Okay, so you already know a bond means you're lending money. You're not the owner, you're the bank. But now the question is, who exactly are you lending to? Because that's where corporate bonds and municipal bonds come in. And yes, it matters. Let's break this down real simple. Corporate bonds are loans you give to companies. Think big companies, brands you recognize. Maybe it's a retail company, a tech company, or even a car manufacturer. When you buy a corporate bond, you're basically saying, hey, company, here's my money, pay me back with interest. Companies issue bonds because they need money to grow. Maybe they're expanding. Maybe they're launching something new. Maybe they're paying off some other debt. But now here's the key. Corporate bonds usually pay higher interest than municipal bonds. Why? That's because companies can fail. If a company goes bankrupt, there's risk involved. So they often offer higher interest rates to attract investors. Higher potential return, but higher risk. Now let's talk about municipal bonds. Municipal bonds, or munis, are loans that you give to local governments. We're talking about cities, counties, and states. So instead of lending money to a company, you're lending money to help build schools, roads, hospitals, or even public transportation. So when buying a municipal bond, you're basically saying, here's my money, city. Now go build that bridge and pay me back with interest. Now here's where munis get interesting. The interest you earn on many municipal bonds is tax-free at the federal level and sometimes even state tax-free if you live in that state where the municipal bond is issued. Now that's big because if you're in a higher tax bracket, keeping more of what you earn matters. Now let's talk about risk. Municipal bonds are generally considered safer than corporate bonds. Why? Because cities and states don't usually disappear overnight, and they can raise taxes if they absolutely have to. They have ongoing revenue like property taxes and sales taxes. But that doesn't mean that they're risk free. Nothing really is. But historically, they're more stable. So let's simplify this. Corporate bonds, you're lending to companies. They have higher interest and they're usually higher risk. And the interest is usually taxable. But with municipal bonds, you're lending to cities or states. They have lower interest and generally they're lower in risk. But they're often also tax-free interest, right? So now let me say something important. Higher interest rates doesn't always mean better. If you earn 6% on a corporate bond but lose a big chunk to taxes, that may not be the 4% municipal bond that's tax-free. It's not about what you earn, it's really about what you keep. And listen, wealthy people understand that difference. They don't just chase returns, they think about risk and taxes. Now, here's the real talk part. Most people don't invest in individual bonds at first. They might invest through bond funds inside of retirement accounts like 401ks or an IRA. And that's okay. The point isn't to do everything at once. The point is to understand what you're in, because when you understand where your money is going, you stop feeling confused and you start feeling confident. Corporate bonds help companies grow. Municipal bonds help communities grow. Both can play a role in building steady income inside of your portfolio. But you get to decide what fits your goals, your risk, and your tax situation. And that's what it's all about. It's about clarity and strategy. Not just throwing money into an account, you're building wealth intentionally. So tell me, did you know that municipal bonds could be tax-free? Drop a comment and let's talk about it. Because the more you understand these things, the more powerful you become. And let's face it, you absolutely got this. This is Toni.